we should be recording now. Hi, I'm Adoni, and I'm here with Sean Friend, who is the Senior Vice President of Cogent Bank. And we are going to be talking about association banking today.
Association banking.
So the first thing we're going to talk about is probably what most people interface with but don't realize with the bank, which is a lockbox.
Yeah, lockboxes. It's this magical place in Narnia. It's essentially a check scanner on steroids, really. So the way that we set them up in the association banking industry is typically it's either a management company will have their own PO box where all of their payments go for all of their associations. And you pair that up with a coupon. You're all familiar with the coupons, right? For better or for worse, the thing that everybody gets at the beginning of the year and then loses throughout the year, and I'm guilty of that myself, so no judgment at all. And at the bottom of a coupon, it has a micker line, which is a magnetic ink. It's a way that the scanner can read it. It's the same kind of coding line that's on the bottom of a check. It essentially gives the association and the unit owner's kind of address within the accounting system or within the bank software system. So what happens is you have a management company sends all their payments to one PO box, or a single association can have it. Most don't have their own PO box, some do. And so all of the payments go to a PO box. Periodically throughout the day or throughout the week, somebody, a courier or a bank employee, or if it's a third-party company that provides it, will go to the PO box. They'll get all the payments out, and they'll take it to a very secure location. These lockbox processing places are incredibly secure locations. You wouldn't think so, really, though. But a lockbox typically doesn't usually just service community associations. They'll service medical. They'll service a lot of things with a lot of laws. So you have these people, and there's a very human, or at least when I spent time in a lockbox, there's a very human component to it because somebody has to open all those envelopes. Nowadays, I'm sure that there's a machine. It's come a long way. I spent time in a lockbox probably 10 years ago. So you have to pull all these coupons and all these checks out, keep them in order, keep them with the envelope, and then it goes into a large check scanning hopper, which then shoots them through. And then it basically takes all of the payments for management companies. We'll speak from a management company perspective here. So it takes all of the payments and puts them into one big deposit and one big file. So then some softwares, the file of all the payments will go automatically. Sometimes you have to go to the bank's software or their website and download a file, and then you loaded it to your village management systems or whatever software the management company will use. And then it gives credit to the specific bank account, and then even further to the individual unit owner so that they have record that they paid their payment and so that the association gets the money.
If you were to physically, when you think about a lockbox, it's multiple things. It's the PO box, obviously, where it goes in, but then it's the thing. So you would walk into a room, and it's a whole bunch of people scanning checks.
It really is. And it's probably less impressive than you think it would be. I mean, it could be, 5 or 10 people, and it could be, 1 or 2 people. It could be 30 or 40 people.
And then, so for different banks handle lockboxes using different people. Some banks have their own lockbox that's dedicated. Some use third parties for lockboxes.
Yes,
and then when you have lockboxes, the other part of it is that most of them, the lockbox is the full payment method. So for instance, at Cogent, you use QuickPay.
Mm-hmm.
And QuickPay provides all of, if you want to pay electronically, QuickPay is supporting that as well.
Yes, sir.
They all have pay in it, Smart Pay.
The lockbox is the paper payment processing system. Some banks do have an ability to create an ACH from within, and we'll get into ACH, I think, a little bit later. Create an electronic payment within the lockbox. But yeah, they're all very electronic, and they all have pay in it, and there's all different types. To your point, some banks have their own. There's a lot of third-party processors, like we mentioned, the QuickPays, the Syncs, the Manticas, and then there are a few larger facilities, specifically in the state of Florida, like I think it's called Checkalt and TMR. Those are also 2 third-party companies that just provide lockbox processing. Most banks will utilize one of those 2.
Yeah, and it's interesting because we have seen sometimes some confusion from different lockboxes because they're processing payments for car dealerships or stuff, and we'll end up with checks that somehow are getting deposited to us from people that, will have an association, and they're like, where did this $7,500 check come from? Oh, we're not quite sure. The lockbox deposited inadvertently, and the bank is having to chase down to find out what happened, and it was somebody's car payment, and they mailed it into a lockbox. The lockbox somehow misapplied it, or it got attached to a wrong coupon, or something happened. And then also there's the times where there is no coupon. It gets mailed back, and you're trying to process it. I guess that's an exception, right?
They become exceptions. So yeah, as you're working a lockbox, again, I said that there's a file that will get either transmitted automatically or manually downloaded into the software. And then yes, there is a queue that you have to go into on a daily basis, really, to be perfectly honest, and take a look at what payments came in without a coupon, or if something just didn't scan right. I mean, it really is it's technology. So if something's written a little bit funky, or what happens a lot, and I don't know if you see it that much, but I mean, I see it all the time in other industries, is if somebody writes a different amount with the handwritten spot versus the check.
And I only recently learned that it's the amount that you have handwritten out. It's not the number you write in that matters. It's that handwritten amount, and they call it the legal line.
Yes, exactly. And checks are only good for 6 months. I've seen a few times where it's been a stale dated check. So there's a few different reasons. Nowadays, a lot of the software has AI, because what doesn't have AI nowadays? And so if you're somebody that just sends the check repetitively, it will get to know, the software will get to know that that's the check you use from the bank, and that's the check stock, and so it should start applying it to the right account within it. So you should theoretically only have to decision an exception like that one time, or maybe a couple times. There's also some technology built into the lockboxes where, given like ClickPay, for instance, if you have a unit owner that likes to use bill pay, if you've ever seen those bill pay checks, they're awful. It's a lot of data they throw on one check, and very little of it has to do with the actual coupon, right? And the coupon's never going to come with it because it's coming from a third-party processing center.
Well, actually, let's talk a little bit about bill pay before we get too far into that. So, just so everybody knows, bill pay is when you go onto your own bank. If you're banking with Bank of America or whoever, you go to your Bank of America website, and you say, I want to send a check to Apple Tree Condo, and it sends a check. And it's a more complicated process than you would think, because bill pay, just like lockbox is handled differently by different banks, bill pay is handled differently by different banks.
It's all third party.
And so a lot of times we'll have a resident that will make a payment through their bank on bill pay, and it shows it cleared their account, but it didn't. Well, it cleared their account, but the money actually hasn't arrived at the association either, which is the reason bill pay creates even an additional complication, in addition to what you're referring to, which is the check arrives, there is no coupon.
Hard to match.
Yeah, and the upper left-hand line, and then on some others, what's interesting is, the MICR line on the bottom of the bill pay check isn't the bank account for the owner.
It is not, no. It's a larger GL that the bank uses to clear all their payments. Some banks do have the MICR line on the bottom that is the actual account number, and some have just a large single GL that they all clear out of.
So I've just kind of always wondered this. Do banks do that so that they make a little bit of money on interest? Because, they're holding that money, right? So they issue that check, the money comes out of my bank account, it goes into this GL account or some type of a general account, and then it's waiting for the person to actually deposit the check for it to come out of. Now, one of the nice things, though, about those general accounts is that it does help prevent a little bit of fraud, too.
It does.
Although I guess if somebody was to create fraud on those, but most of those accounts, I would think, use positive pay, those general accounts.
Yes, you're exactly correct. Every bank GL, every account that comes out of a bank definitely uses positive pay. Do you want me to go into positive pay?
Yeah, why don't we talk about positive pay, and then we'll talk about different types of fraud as well. But I think positive pay has been one of the best things we've done as far as having an integration, and I do appreciate what Cogent and other banks have done to have us have that integration for positive pay.
Yeah. So positive pay is essentially when a management company does a check run to pay their vendors, to pay the people that do the work for the associations or for the management company, they can export their entire check run into what is essentially an Excel spreadsheet. It's called a CSV. It's essentially an Excel spreadsheet. And it captures the account number, the amount, the payee, and the check number. It captures all that information, and and it goes into a bank database. And then as checks clear from the association accounts or the management company accounts, we only clear the checks that match that list. So it really holds fraud up. There's a couple exceptions, like it'll never catch endorsement fraud.
And also, just to bring it back, when a lot of people think that banks are kind of like your credit card, where you get the statement and it's 30 days later and you can say, oh, this isn't my charge. It doesn't work that way with a check. So one of the reasons we have all of the controls that we do and we issue checks, and it takes us longer. So from a management perspective, we do emergency checks. We have the capability of issuing a check as an emergency check, and
Absolutely.
it will become an exception, because when we do emergency checks, it's actually not going to show up on the positive pay list.
It will not.
But we'll process it as an exception. But one of the reasons it takes us so long to do it is there has been so much fraud, and we're trying to create all of these controls.
It's unbelievable. We could go into an entire whole offshoot in fraud.
But when there is a check, you have 24 hours to
basically
one business day. I think
the ugly truth about fraud as it relates to businesses is all of the rules that are built from regulations perspective are built to protect the consumer, not the business. So while a consumer has 30 or 60 days to challenge fraud on their statements, a business can have as little as 1 day. Sorry.
And that's where an association is sitting. So when a check clears, if it's fraudulent, unless somebody is checking that bank account every single day,
And who has enough staff for that?
and it would be cost per. You couldn't.
You couldn't
the
possibly
cost
staff
of
up
doing
with that.
would be impossible.
Yeah.
But Positive Pay pretty much provides us that ability, because nothing's going to clear unless we've loaded it into Positive Pay.
It's a huge safeguard. It really does virtually eliminate the possibility of fraud. And you made it, so I want to make sure we follow up. So there are, again, exceptions, sort of like how you have to look at your lockbox exceptions. The one of the drawbacks of Positive Pay, I always tell people, one of the drawbacks of Positive Pay is that you do have to check an exception file on a daily basis. I mean, even so, in Hurricane Ian and Hurricane Milton, when we were shut down, we had employees sitting there hunkered down in their rooms, reaching out to clients saying, hey, you haven't decisioned your Positive Pay. And so these checks are going to go bad. Now, in that instance, I think any vendor would be understanding, like, hey, you had my Positive Pay. I didn't have a chance. We were in the middle of a hurricane. I didn't have a chance to check, but we were trying at least to reach out to people. But so every day, you have to have people that go in and check those exceptions to make sure that the checks are being either returned or paid.
Now, in addition to, you mentioned ACH. So when we're talking about right now, we're talking about everything as checks. It's physically printed checks, which have that micro line at the bottom we're going over. ACH pretty much has the same information as what's on a check, because it's the routing number and the account number, which is what you have on a check. But I think that a lot of people think that ACH actually works in the opposite way that it does. When ACH is initiated from the association, it's the association going into a person's bank and taking that money and pulling it out and putting it into the association account. There's some positives to that. I'm personally a fan of ACH because the mail has been poor.
I'm sure they're going through their regulation and staffing issues as well. And paper is there's always going to be things that get lost.
Well, but there's also been, it was just in the newspaper a couple of weeks ago in Naples, there's people that are going into mailboxes and just taking stuff out of people's mailbox.
Oh, from a fraud prevention perspective, especially when you're talking about paying vendors. Now, we're not even talking about, associations pulling the money in from their client, from their owners.
Yeah.
When you're talking about paying vendors, I can tell stories upon story about business owners that just have, the most common fraud is, you're paying a vendor that has their mailbox that's still on the street. People just drive down the streets, go in, grab the checks out of it, and then go off and what they call wash it. They'll change the payee. They find somebody that's not on Positive Pay. That check gets cashed, and people steal the money. And it's a very fast process. There are entire rings of fraudsters out there perpetrating this kind of theft. And unfortunately, it works because people just don't check their bank accounts as often as they can or should. I don't fault anybody for that. Who has, business owners have to run a business. They don't have time to be logging into their bank account all day long, every day. And even, we've even had clients that had their mailboxes locked to their building. I mean, people with cameras on it.
That's what we have here. We've got the mailbox with it's got a lock on it. So because the post office, they're going to deliver it to the box.
They are.
I mean, if you have a large box of mail, they will bring it in if they've got the crate. But if it's a few pieces, they're not going to bring it into you. So it's going to be out there. So unless someone's sitting there watching it, and then the problem is on Saturday, do you just have a person working on Saturday just to go out to? So you've got to lock your mailbox.
Absolutely.
And if it's not locked, it creates a. But on a residential side, that's very difficult, particularly for people living in our associations, because there's requirements on what the mailbox looks like, its size, its color, all of that. So now they can't.
It's a whole point of pride. People spend a lot of money on their mailboxes.
Yes,
these days. Given the ARC requirements, of course.
Yeah, I'm thinking, in the future we might open a mailbox company
there you
because
go.
mailboxes are thousands of dollars.
They are.
It's really,
well protected too. It's a federal crime if you tamper with it.
Yeah.
There you go.
So ACH, we go in, we're pulling that money,
yes.
placing it over into the association account, using that. There's less of a chance of fraud on that. Now, associations also use ACH when they're issuing payments out to vendors, and sometimes there are some controls you can put on that, different filters and things. But
there's a similar product. There's ACH Positive Pay,
yeah.
which is essentially sort of the same thing. That's more that's more driven. I mean, if you're loading it into the system, there's virtually no fraud unless somebody on the other end, sort of the same way that like wire transfer fraud happens, where somebody intercepts somebody else's email address, they go and change the bank information. So you have to be really cautious when it comes to that.
Yeah, so wire transfer fraud is the thing that there's like 5 things that cause me to have difficulty sleeping at night. Wire transfer fraud is one of them. And the way we've gotten around it is we don't do wires.
I was going to say there's very few associations that do wires.
Yeah, we just we don't do it.
And I fully support that. As a banking officer, I have to sign off on where I used to. I don't in this position. But I used to have to sign off on wires, and nothing will, you no more, to your point, fear than signing off on a wire, because once it's gone, it is gone. ACHs can be recalled by their nature. Wire transfers, you have to have the bank on the other end participate in sending it back. And if the fraudsters on the other end are working quickly enough, they can transfer the money from account to account to account, pull it out. Once the money's gone, it's gone.
And the fraud on that is so sophisticated. The spear phishing fraud is so sophisticated. There was a situation where I was the manager, this was years ago. It was a large project, a large lake project. And each one of the draws was in the millions. Yeah. Every time we'd make a payment, it was, it might have been $800,000 on the low end, but it was usually over $1 million. And we had the treasurer at the time, and they wanted everything paid by, they were allowing wire transfers, and it was a huge account for Newell, and it was one of the times that I agreed that we would allow it, and we broke our policy. And we tried convincing them we will FedEx checks, but we had to do wiring. So the treasurer was on vacation. He was in Australia, and this email comes across to me. So the process before for this had been that a payment application would get submitted. It would go to the engineer who was overseeing it. The engineer would approve it. It would then go to the bank. The bank would then fund it. Then it would come to me. I would go and initiate the wire transfer from the bank to the other party, the lake party. And the treasurer's in Australia, and he has to sign off. And he signed off, and he sent it to me, and they're really pushing to get this done in the morning. And I happened to have some meetings. And I knew this treasurer quite well. His name was Tony, and we always had a great relationship. And he was, on top of me, rude with these emails. And it just did not feel right. But I couldn't get a hold of him because he was in Australia, and we ended up holding it up. And the whole thing was fraud. It was somebody who had hacked his bank account, had hacked his email account while he was traveling, had created everything fake to include the engineer's seal. So it looked like the engineer had approved this. It had gone to the bank had funded because the bank had received everything from Tony to fund it. And then, I'm sitting there, and it was just, if I hadn't had meetings and there hadn't been that sense of urgency, and I saw him being rude and basically saying that we're going to fire you if you, and I'm like, why would he ever fire me for this?
Yeah,
we wouldn't have caught it.
When you feel urgency when there typically hasn't been in a relationship, that is one of the major red flags. I teach a class on fraud. One of the main themes, I have an entire slide on this, is fraudsters want to make you say one thing. I didn't even think of that. Like if you utter those words out loud, because how many times have you made a mistake and you weren't there? Oh God, I didn't even think about that. Once you say that, chances are things have already gotten past that point of not no return, but where you're going to have a little bit of hazmat work on your behalf. But yeah, if somebody's pressuring you, not almost always, if somebody's pressuring you, it's a huge red flag.
Yeah, and the nice thing, there's a lot of positives to having lots of steps in payment, and I know that vendors don't particularly like it, but the having the steps of so in this case there was a loan. So in order for the loan to fund the funds, we had to submit the engineer stuff. So that created the engineer requirement. Having all of those steps in there is very helpful, because if you can slow roll that payment, it really does. It buys you the opportunity to look at stuff, and that's one of the positives of loans and requirements. So, what is the strangest thing you've ever made a loan on?
Oh man, you asked me that question earlier, and I'm not.
I've just dropped it on you again.
Yeah,
What's
I know.
The weirdest loan?
The weirdest loan. I don't know. Just in the nature of what I do for a living, if I've made any weird loans necessarily. Gosh, let me think on that. We'll circle back to that.
All
Okay,
right.
I'll keep that running in the back. But really, I mean, in all honesty, I've made 1 million home equity lines in my career. I've lent people money for trucks. I've lent people money for machines used to make like these beautiful paintings on walls, like printing machines, commercial buildings. Done tons of rehab loan works for community associations. But as far as like weird things, I don't know that I've ever lent money for an odd thing.
Have you ever had to do loans for settlements? Or loans
for like a legal case?
Yes.
So most banks, whether people realize it or not, don't like to get involved anywhere near.
Well, that's the reason I'm kind of wondering, because I'm going to talk about loans and what you can get a loan for and what you can't, and the difference between a credit line and a loan. So, have you ever done it?
I've never had a credit officer be comfortable being anywhere near a lawsuit, and it's been more problematic around the hurricanes the last few times, because there's been so many lawsuits that have happened after the fact, and credit officers. The way banks are set up, right? You have lenders who are like the salespeople on the front side. We're the people that go out into the community, make relationships, meet people, talk through scenarios, structure loans so that way they meet like a credit policy. And then you have the people on the backside, the credit officers, and they're the people that ultimately I have to sell the loan to. They're the people that kind of run through the financial analysis, and they're the ones that kind of say yes or no. I'm more the salespeople. The commercial lenders are more of the glass half full type of people, and the credit officers are for sure the glass half empty type of people. And it's just the way things are set up. It's a yin and a yang. And what's difficult is for credit people, there's no incentive for a credit person to approve a loan. There is none. There's only disincentive. Like, they don't get an attaboy when a loan pays off in full. Like, somebody takes a loan out for a 5-year concrete restoration. They make 60 full payments. That loan pays in full, or let's say even better, they paid off in 48 months. They paid it off a year early. Congratulations to the association. They saved a lot of money in interest. Nobody's congratulating the credit officer. That's how it was supposed to go. On the other side of the coin, if things go awry and somebody stops paying, or if there's a lawsuit or something like that, they can lose their job. They could, there's only downside. So that's where the industry's built this way, and it kind of holds you accountable, and it's a good process. That's why as a lender, I really have to know my scenarios. I have to understand the clients. I have to understand what they're going through, because I get put in a meeting where I'm sitting across from the approvers, and I have to know my stuff. I've read a book report on you. That's what I was called it. It's an officer memo, but I have to read a report, understand like the milestones and the SIRs. I mean, I have to dig through those stupid things and understand, has the association done everything? Are they taking all the right steps? And maybe I'm getting ahead here, I'm sorry. So if your credit officer, and I can speak to most of the banks I know, if they see the association is embroiled in a lawsuit, they do not like it. Even if the association takes the steps, and I've argued this. I've had some, they're suing their insurance company, and they know that they need $3 million to complete a project, and so they're just going to bite the bullet. They're just going to assess the $3 million. I think it's the fear of the legal fees or something like that. There's still a lot of unknown in there, and maybe most credit officers have been doing it for a long time, because I know it's probably different in your world. It's hard to find people. It's really hard to find people who want to do credit analysis. Like, nobody wants to do numbers anymore, and so most of the credit officers have been through the Great Recession, been through some tough times, seen lawsuits on the bad side, seen losses taken by banks, and so they're just very afraid of lawsuits. assets in general.
So, but with an association, what is the collateral that the bank usually wants?
Well, the collateral is almost always, and I mean almost always, going to be the assessments. So the way a loan is structured to a community association is the association has a need, right? They have some financial need. They need to complete a project, whether it's a repair, whether it's an improvement, whatever. They've got a financial need. They don't have the money in reserve for whatever reason, and so they have to create an assessment. And so then most of the time these days, a loan is structured and there's a special assessment. That's just kind of how things are going. You can either add it to the general budget, the debt service. Maybe we can get a little bit ahead here. You can add the debt service to the general budget, but if like say you're in like June, do you want to go back and amend the budget? Probably not. Right? It's more to pay. Or you can do a special assessment, or you can kind of do a combination of both. And so the special assessment, a lot of times they say, okay, everybody in Rosewood Commons B, let's just make something up. You owe $10,000. You can pay us $10,000 in the next 30 days, or we've negotiated with the bank, and we've created an assessment where you can pay the $10,000 in $350 payments for the next 4 years. I don't know if that math actually works. And that's the part where I create the loan against. So we loan against the assessments, your assessments, for the portion of the assessment that's paid over time. Does that make sense? So,
yeah.
And then,
but you basically are, the collateral is that you can force a special assessment.
Essentially, yes. So what we do is we do a UCC on all your assessments. Now, a good attorney will carve up a lot of stuff out of that. Like, I mean, we're not allowed to collateralize reserves for other line items. But most of the time, it doesn't go through and have an attorney nitpick that stuff out. So banks just do a blanket lien, which means all your assessments. So they do, I mean, I don't want to go into the full legalese, but it'll say something like any and all assessments until the loan has been paid in full, and any special assessments that arise, any future special assessments. So you're kind of married to that bank until that loan is paid in full. And a UCC is just a lien placed, it's Universal Commercial Code. It's just a lien placed with the state against something that's not titled, right? I mean, if you can't,
it's basically the cash.
It's the cash. It's the cash. We can't take your actual reserves again because your reserves are line itemed out for other things. Like I can't take your roof reserve for a paver project, or I can't take. I don't need to go into any more of those. And then a lot of people have asked, can you take the common elements? Are you going to take a mortgage on anything? We don't. Bank.
Take your clubhouse.
Yeah, exactly.
Take the pool, the Cogent pool.
Yeah, I think maybe Kyla can speak to why we can't do that from a legal perspective. But also, I mean, if you think about it from a value perspective, your pool, your clubhouse, your common elements, like if you're talking about a condo building, like the walls in between the units, the slab, what are we going to do if we force close on that? How are we going to sell that and get any money back out of that? So it's not really of any true value to the bank. I mean, if you want to play devil's advocate, it's going to be really hard to get the assessments too. I mean,
have you ever had an association default?
In all of my years, let's knock on wood, I have not. And I was a lender through the Great Recession. I see association loans as very safe, secure loans. There are a few, in a bank policy, it'll have a few, I call them knockout reasons, but a few points that we have to pay attention to. High levels of rentals, high levels of properties owned as an investment. Because the theory behind that is that somebody's a whole lot less likely to walk away from a primary residence or even like a second home than they are just an investment property. If a family gets into tough times, they're not likely to stop paying on their first or second home unless they have to. Delinquency, just in general, developer turnover is a tough one because those are really muddy. But those are some of the knockout reasons. But if none of those exist, then they're really, really very approvable loans. Because you've got, if you think about it, if you have a community association that's built of 100 families, and let's say it's 95%, primary residences, what has to happen in the world that 100 or 90, all those families are going to stop paying their statutorily required assessments to the association? I mean, you're talking major financial collapse. So, I mean, the bank I worked for through the Great Recession, we failed and another bank bought us. And some of the first loans to get pulled out of the workout were the community association portfolio. It just, by and large, they don't go bad. I mean, you have Champlain Tower, a situation where something like that's going to go awry. A major hurricane, and the association ends up going, they're going to end up selling.
A disillusionment or something.
A disillusion, yeah. But I mean, ultimately, you're going to get paid back through that. You're not going to fully write that thing off, but it's going to be a non-performing asset, and there's collateral, or there's capital issues with the bank. Like, you have to tie up your capital for years and years and years, and you're working through that with regulators, and it's really painful. So, I mean, but you're not likely to take a loss with the community association.
So, money coming in, lockbox, loans, money going out. What other services do banks do?
Well, banks do a lot of services. I mean, for community associations, the biggest thing that's changed over the years with community associations, when I first started doing this in 2005, when I first started working with community associations, it was you had to have a lockbox, you had to have an ACH facility, right? We kind of talked through both of those things. And then you just had to have a department of the bank that knew how to work with the management company. Because a lot of times you're working with bookkeepers, you're working with the accounting department, working with boards. You can have some very, not just people that are very concerned with things, sometimes for good reason, sometimes, not so much. And so there's more nuance to it. But that was really what you needed, those three components. And then you also, you would talk about, I think one of the questions is, we're going to go into, your know your customer, we call it CIP, Customer Information Protocol. It's a regulatory thing. We'll get into that in a second. But you also had to have reasonable CIP processes. I'll use that acronym since I put it out there. Nowadays, it's a lot more complex because now you've got all these data connections with all of this software. So there's the third,
the ACH audit or whatever.
The ACH audits is a whole thing because management companies are looked at from the government as a third-party payment processor, and you guys are holding a whole lot of financial information. So it's the same reason, like, we couldn't just go tour a lockbox now, especially one that has medical. I mean, for HIPAA, you cannot go anywhere near that. It's a very secure facility because of all the information that people have now for the owners. You have these audits that have to take place, and some are more onerous than others, as you well know.
Yeah. Some are just a warm cloth wipe over, some little deep.
Well, a lot of people, I don't want to go into like the nuance of it, but basically, as a bank, ACH, we have to underwrite certain types of ACH facilities because if you're pre-funding an ACH, like the money's already in the bank and you're sending it out, there's very little risk to that unless somebody's like committing fraud. But if you're not doing pre-fund, or if you're giving somebody the ability to go into somebody else's bank account and pull money out,
like with the Nacha files and all that,
you have to underwrite those so that way you understand that in a bad situation, the originator of it has the cash and then also has the character and all that. I mean, there is a lot of risk involved in it, and typically the facility that a community association would need, I mean, back in the day, or even now, I mean, you need $5 million or larger ACH facilities, which is an entire number. I mean, there are Fortune 500 companies that don't have a $5 million ACH facility. No. So it's a lot of money being pulled all over the place. So I was going with that, but then there's also, going back to products and services, now the banks have to also have data tie-ins with these software companies like the Village Management Systems, and I mentioned a few others, the Syncs and the Manticas and the ClickPays, right? So we have these third-party processors that we have to have these very sophisticated softwares written. It's either APIs or SFTP, which is a little bit less sophisticated. And in some instances, you have to have a third-party company called a middleware company write software.
We're spending lots of money on those folks lately.
It's very expensive. It's very deeply onerous, to use another word. And some of these softwares have pay to play, like an annual fee that you have to go into. And so it's really, and then, when, you and I are trying to provide service to kind of the same, like we kind of manage clients together, right? I mean, an association comes to the both of us and says, you're going to be my banker, you're going to be my management company. We both have a huge vested interest in making sure that they're kept incredibly happy. When you start to deal with the third parties,
Yes.
slow things down. That's a little bit of a nuance. And I don't know. I mean, you said what other services do we provide? I'm kind of going. I mean, but in this space, a lot of that. This is really more relevant. I mean, yes, we've got checking accounts, we've got loans, we've got credit cards. Credit cards are another huge one that are really important in the community association space, since you cannot have debit cards.
No debit cards.
No debit cards.
We've had this conversation recently because, and then the other problem with the credit card is, so one of the things we need to pay the most quickly will oftentimes be insurance. Except it's $80,000 or $100,000. And
they'll let you know a week at a time.
And well, days, maybe days to pay something, right? Yeah. So you can't use a debit card. But does an association have a credit card that'll support $100,000?
Not likely. Most association credit cards are $5.
Yeah, and that's the most. And so now we're having to come up with creative ways to do that, which there are virtual credit card options and different things that we've been able to use in that. But and I understand why the statute exists to get rid of debit cards, but I could have paid that $80,000 bill with a debit card.
In my career, I've gone from credit cards, and then I remember years ago when I was still working at the bank before the other one failed, then we had to go to all debit card accounts. So you had to open all these debit card accounts up. And then a couple years later, it was debit cards were bad, go back to credit cards.
Go back to credit cards.
And then debit cards popped back up a little bit, and now it's back to their bad again.
Yes.
To your point though, with
give it a couple of years, guys.
We'll be back.
We're going to be back. Credit cards will be off the table. We'll be back to debit cards.
Actually, they'll come with now you have to have a payment card, a P card program or something like
yes.
that. Yes. I don't know. There'll be something wonky like that. But if for that instance, an association could go to a bank, this bank, whatever bank, and say, I would like a line of credit. I use what's called an officer's guidance facility to pay for the insurance premiums as they come up. And what it is it's a little line of credit that sits out there. It doesn't have to ever be used, but it can be used. And if the association wants to, a lot of times they get this through the insurance company, like financing of insurance premiums, but it gives them a little bit more flexibility on the bank side. So they can come and say, okay, our premium is $80,000 this year. We want to utilize that. And so then the way my bank policy works is if you're going to finance the full $80,000, I have to have it termed out in 10 months because we want to make sure that you've got a couple months there free and clear for saving back up. We want to make sure that basically the premium is paid off. Or if you're going to finance 80% of it, we can do it over 12 months. They just want that like 20% prepayment. So it's something, I don't do a ton of them, but they're there. They can be utilized.
Well, usually when we're using the credit card, it's not because they don't have the funds. They have the funds. That's the reason the debit card would work. It's just that it has to be paid so rapidly. So you were mentioned you go to bank. You worked for a bank that failed.
I did.
Why don't you tell us what that was like?
That was a very interesting. When I first moved here. I mean, I moved here from Illinois and went to work. And I went to work for a company called Orion Bank. The manager I worked for had a huge book of business and community association. And that's really where I learned to do this. But it was a pretty rapid decline. We're talking about June 05 till, I always say it wrong, November the 13th, 2009, but it was a Friday the 13th too, which was, also interesting. And so when I went to work there originally, there was a lot of nuances to that place. Like I was from the middle of Illinois. I had just started working in banking a couple of years before that. I think the largest check I ever saw was maybe $200,000. I mean, middle of Illinois. I mean, it's the corporate home of State Farm. It's a nice town, but there's not a lot of affluence there, And then I moved here and I went to work at the new account desk for Orion Bank, and I'm opening $5 and $8 million CDs like every day, all day long. It really was kind of anxiety producing because it's just, you see these numbers, people are pulling in Ferraris, there's celebrities walking in and out all the time. So it was this really like, when I went to work, there was this really impressive, very proper place. And then through the Great Recession, the CEO kind of decided to fight with the regulators more than he should have. Did some things that he shouldn't have done from a structure perspective. I think too far into it. So I remember one day, the Great Recession's hitting, and we got asked to sit on this conference call. There was an agreement we had entered into with the Fed, to get ourselves out of it. And that was like the first meeting of a few meetings that ultimately ended up in that Friday where I had to stay very late, and we had to audit everything inside the branch. And another bank had purchased us, named Iberia Bank, and that's where I worked until June of 2020 when we started Cogent Bank. But it was really like working for two different institutions. predictions, from the day we went there until the day we went down. Interesting things. The day we failed, I was the floating branch manager at that time, and I was actually working at the corporate headquarters. So I went into work that day, and you could tell there was news trucks outside, but late in the afternoon, the black cars, the sheriffs sitting outside, they were wheeling stacks of boxes down into the mail rooms, in advance of it. Lots of stories which we'll tell another time, but it was a very weird time.
So when a bank fails, there's insurance on
Yes, sir.
$250,000 per deposit.
Yes, sir. Good lead in.
If you have more than that, and also those deposit relationships, because we're talking about services that the bank provides, and a couple other of those services are ICS would be an example of it.
ICS and FDIC insurance.
And so when we have an association that has in excess of $250,000 with bank, and that could be in CDs too, right? Because it's everything that's with that bank. We usually look at ICS. And first off, I think ICS is a great product. I like it. Mm-hmm. I accept that, and you work at the bank, so you probably could. Reconciling an ICS statement's a little different for me.
Okay.
I realize that the whizzes over in our accounting department are able to do it. The shadow account thing confuses me, and the last transaction goes out, the last transaction goes in. One or the other, I can't remember. Well, something about the last transaction doesn't count.
That's probably on the record.
Oh, you're like, I don't know this either.
I apologize. I don't know that part of it.
So I know that it's more work on accounting side to reconcile ICS statements, but we can put $4 or $5 million into an account. Mm-hmm. Well, because what happens is the ICS statement isn't a regular bank statement.
Yeah.
It's not like, here's your money, here's where you spent it coming out, and then. Well, first let's talk about what ICS is. So what is ICS?
Essentially, ICS boiled down is it's a network of banks that all participate together, and we pool and share our FDIC insurance limits. So then to go back just one step, every association is insured at $250,000, and it's per tax ID. So some associations have the boat entity, or they have a couple sub entities which kind of indirectly wrap up into one. So those would have excess FDIC insurance, but you wouldn't just route money there for no reason just to get it around FDIC, right? So if an association only has $250,000 in FDIC insurance, given the marketplace, then you have to, from a fiduciary perspective, be as FDIC insured as possible, right? That's the director's job, is to make sure that the funds are protected. So they can do a few different things. They can run around town and open up CDs and money markets all over the place to get 250 at different banks. Or they can utilize ICS, which again is the way to have one bank account, or really two if you include the shadow account.
Because the shadow account.
But we call it one bank account at one bank, but be insured up to $50 million. And I've seen it actually in work. Or I've seen it in action, right? I've been using it since 2005, since I moved here. Originally, it was just CDARS, C-D-A-R-S. I can't remember what the actual acronym stands for, but it's the CD version. ICS is the money market side, and CDARS is the CD side. But it's the same. It was originally a company called Promontory.
Yes.
And then they were bought by IntraFi, which Promontory, I believe, was founded by a bunch of ex-Federal Reserve board.
What I was told.
Yeah.
Very smart group of people.
Yeah, I mean, in all honesty, it really was. It's a gap, right? I mean, because if I'm a board director and I'm overseeing a $5 million budget and I've got $3 million in the bank, it's not getting lost on my watch. There's another thing that I would actually lose sleep over that. So I respect infinitely the use of it. So I said I've seen it in use. Last year or 2 years ago, when we had the actual bank failures, around the first part of the year, Silicon Valley Bank.
It was 2 years ago.
I think it was 2 years ago. That time flies.
Yeah.
A few of those banks were part of the ICS network. And so I saw on the back of an ICS statement, it'll show you where your funds are being shared. Understand that there's no money being ACH'd around the nation. It's all done. It's an accounting function. It's balance sheet It's just, it's we have 250,000 of Silicon Valley banks. Well, let's not use them since they don't exist anymore. But we have 250,000 of, I don't know, Chase Bank, and then Chase has a reciprocal. They have 250 of Cogent Bank. So it's just an accounting thing. But to have that $50 million insured and see on the back of a statement, it go from the bank that bought it to the bank that was the receiver or the bank that purchased, and have the association not lose a single solitary second of access to their cash. But it was cool to see it in action. This stuff's all theoretical. You talk about it, and then to actually see it in place.
Yeah. So ICS. Now, I'm just curious. So the nice thing with ICS is we actually have pretty decent rates on ICS accounts as well.
We try to be competitive as possible.
And
it costs about a quarter point.
Correct. So there's a cost to it. And I just also everything with the bank's doing, we're talking about services, there are costs to all of these services. Lockbox has a cost. Now, for 99.99999% of our associations, they don't pay anything. There are some that have negotiated their own deals, and they have their own lockbox, but they have their own returns, and it works out.
That is fair. That's the exception, not the rule.
Yes, we try to keep to be honest,
it's more complex for your company too.
Yes, we try to. Generally speaking, it's in everybody's best interest to just let the bank do their thing with their lockbox.
The mass lockbox works, and you've got the positive pay controls around a lot of things. I mean, there's a lot of controls that are built around it, a lot of efficiencies.
So there are costs. Now, CDs are another thing that banks tend to do quite well for us. Again, there still count towards that limit though. So there is CDARS as well.
CDARS is the CD component. It's a bit more, so ICS is the money market component, but for us, we're online with IntraFi. Sorry about that. We're online with IntraFi, so money can be transferred intraday to and from. There is technically a cutoff in the day, but it really just, with disbursements, it never really affects anybody. With CDARS, they with the way we do it is they always mature, right? And then we ask the client what they would like to do to reinvest it. So there's drawbacks and there's benefits to CDs, right? So a CD is basically, it's a time deposit. You're going into an agreement. It's a legal contract with the bank saying, I'm agreeing to place this $250,000 with the bank for 9 months in return for a slightly higher interest rate. It's so that the bank can count on having that much in deposit so that they can go about their financial. I mean, banks are for-profit companies that make money, holding deposits and lending it out, and they make money on the margin in between, right? So the more certainty, the better for the bank. The better for the bank, the more return they're willing to give. Now, in a storm, if an association has the need to get after some of that money early because something unforeseen has happened, if it's a bank CD, more often than not, your bank's going to work with you and waive penalties. When you work with something like Cedars, as a third-party company, they are not going to waive penalties. And depending upon the timing of it, you can also cut into principal. So you have to be very cautious as a board member when you're laddering these things out. I had an association recently. They did T-bills, right? So it's just another investment vessel that's protected. They chose to do that. They chose to ladder them, and then they started a project, and the project started a little bit early, and they had to decide what to do to get after some of those funds early because they were going to have to break one of their T-bills in order to pay the developer. So that was a little bit uncomfortable for them. And then there are also a lot of, investment people out there. Investment people work at brokerage houses, and they're great, especially with the nature of what we do, the nature of the makeup of these boards. Lots of people in Southwest Florida have lots of money. They've got an investment person. That investment person's probably done very well for them, and those people can offer products and services. You just, to the point we made earlier, you have to be very cautious when you're using the association's funds. Number one, the principal has to be backed. They cannot take any bit of risk. You don't see that request very often anymore.
We've had a few of them. We've had two associations that voted to be able to invest in the stock market, and they were using mutual funds. And
it's a big risk.
It is, and it worked out well for them. The time that they were in, it worked out well, and thankfully, they had a change in their leadership. It was one of those situations where, again, we're the management company, so unless it's illegal, we're not going to say no. But we
provide advice, and then
they
do what they want.
And so we put into writing a couple of different times concerns about what was being suggested. Finally, when there was a change in leadership, they decided to pull out, and it was great timing because it was right before COVID.
Oh man!
And so, I mean, If it had been 3 months later, it would have been a real problem. And so
that's
it
scary.
was a good timing. It worked out well for them. It was money that they had from insurance, and so they were, they were trying to continue to have gains on it. But so going back to ICS and CDRs, you were talking about timing. So one of the things, reserve accounts, more often than not. So for smaller associations, they've got less than $250,000 in. The reserves are in money markets. Now, money markets have restrictions on taking money out.
That was driven by a regulation for a long time. Again, it goes back to providing banks with the certainty of having money on deposit. That regulation has since been lifted, but a lot of banks still do have restrictions on the number of times. Most money market accounts, you can't make withdrawals more than 6 times a month, and then there are some kind of fees. It used to be a regulatory fee. Now it's just all banks still have fees on anything more than 6 a month. That's.
But on ICS, there is no such restriction.
No,
So I'm just, again, this is a question I truly don't know the answer to.
Okay.
Let's say that I have $200,000. Can I put it in ICS?
Yeah.
So I could use ICS
You could use
instead of a
ICS.
money market to give me still a rate of return. Might not be as good, but it should be pretty close.
So that you could transact business.
So that I could transact more business if I needed to.
You could if you wanted to. What most people do in that instance is they use the money market account as the savings vessel, and then they
just
use
move
some
it to
kind
the
of
operating.
a disbursement
that's
account, right?
usually what we
So
recommend.
you'll just move tranches of cash. Like I've got to do 6 checks totaling $50,000, so you just move one tranche, and I don't know. You tell me. Here's a question. I don't know. Would it not be better to have most of those disbursements come out of the operating, so that way, if you're looking back at where the funds came from, you don't have to look at both? Or is it prohibitive from reserve commingling of funds?
So that's one of those things that depends oftentimes on the treasurer and how they want to account for things. For association accounting, the reserve bank account is an asset, and the reserve liability is obviously a liability, which you're going to spend money on. So let's say we've got a $300,000 roof project, and it's going to be, we're paying them out in 10,000, 15, whatever. Some associations, we're going to start with my least favorite way of doing this and go to my most favorite way.
Okay.
So my least favorite way is we just expense it directly out of that bank asset and the liability. Those are the two accounts that get hit. The positive on that is that it does not in any way impact what's happening on the operating side. So if somebody sees a surplus or deficit position of the association, it hasn't been perverted by money that's being spent from the reserves. The negative of it is it's kind of hidden, because unless you knew there was $300,000 in the roof reserve and the next month there's $290,000, you're not going to see the transaction. So some folks, and this is one of the more common ways, they create a contra account. So you'll have 2025 roof project as a contra account for that liability. So the money is spent out of the asset, and the liability is basically a negative liability, a contra account. And so that keeps everything in balance, and you can see that 2025 roof project spending the money. But when you do that, every check has to be written out of the bank reserve asset. Okay. If that is in a money market account, if you've got a roof project going on and a painting project and a pool project, well, you have to hope you don't write more than 6 checks out of there at the same time in that month. Now, the other way that this is done, and this is another way, is you can take those funds, basically move them from the actual reserve asset into the money market asset. You can account for them as income on the income statement and then just be balancing it with the expense. So let's say you're going to spend $300,000, you can bring in that $300,000, and then as you're spending it, you keep those in balance, the income side and the expense side. That still will not have an impact on the real operating position. It shows the funds transferring, so it just kind of depends. Depends on how they want to account for it.
That was Fun with Accounting with Adoni.
Fun with Accounting.
That's a podcast idea.
Yeah. We'll add that for one of our podcast videos.
I would actually listen to that.
Fun with Accounting? Yeah, we'll know what to add. So, last but not least, I want to understand bank strategies.
Okay.
When it comes to rates and all that, because one of the things that we encounter often is, I call it chasing rates. It's been my experience that this is a safe space, right?
Okay, man.
to be honest with you, there was a period of time where I didn't know of another bank other than Iberia to bank. Because it seemed like out of everybody we worked with, Iberia consistently got it right. They knew what they were doing.
For the record, I worked there.
Yeah, you worked there at the time. Yeah. And I'm talking 10 plus years ago.
Yeah.
And then it seems like in the past 10 years, all of a sudden people woke up and they want association funds.
No, that is absolutely the case. Attend any trade show.
Yes, and all of a sudden we went from Iberia, which was it. And then the funny thing was, actually I remember going to trade shows and Iberia would sometimes show up and sometimes not, and there was no other bank. Like nobody even wanted to deal with these weird associations.
They were the 800-pound gorilla and they just didn't have to market.
Yeah.
Yeah.
But now you go to whatever, whether it's CEOC or CAIs or COMA or any of those things, you've got 3, 4, 5 banks that are in the room. Plus, you have folks that are trying to, from brokerage firms, are now trying to target associations. And usually they lead with rates.
They do.
This is the rate we can get you. Yep. So I'd like to understand bank strategy, with Cogent and all that, because you work off of a margin, right? You're going to pay a certain rate. You're going to, on this side of it. From Newell's position, we just want good partners.
Yeah, absolutely.
And, as you know, we don't just partner with Cogent. There's other banks that we work with. Some banks are better than other banks. I will say it to you.
I get it.
You guys are good. I'm not gonna, you guys are very good. We're very happy partnering with you. What's the strategies? How does that work? How do you guys make money? And how do they do these other, like the promo rates? Or I guess what gets us is because we have moved banks for
a promo rate, and
then 3 or 4 months later, it's gone, and it's expensive. So associations, we try not to, but when an association changes, there's a cost. We have to pass that on somehow. We can't say it doesn't cost us anything to change banks. And then the association's frustrated because 3 months later, that 4.5% return or whatever that they had sitting in an operating account that was truly too good to be true is gone.
Yep.
We're at 1%. So how often can you reprice? How often does that work?
Consumers even see that too, because I'm sure everybody gets that. Like, I have a Chase credit card. Every time I open it up, they're like, "Hey, if you move your checking account, we will give you $300." Why would you give me $300? But okay, so banks make money, to your point, on the margin between you have funds on deposit, and they're a liability from a bank's perspective because they're not our money. We have to give it back. We have to give it to somebody. And then we have loans that we write. And so whatever we pay in interest versus whatever we're bringing in interest, what we pay on the deposits versus what we're bringing in on the loans, that margin is where banks live. That's where they make their money. Now, there are other ways, right? There, in this day and age, and I'm not talking about like overdraft fees or anything like that. And especially not in this space, we're not even talking about like treasury management fees.
We can talk about treasury management. We can come back to that.
We can talk about treasury management. Which treasury management is the division of the bank that produces like all the technology, right? So we talked about like the positive pays, the ACH. That's the division of the bank where all of that lives. Some industries pay for that. Some industries don't pay for that. I've always said the market dictates who pays and who doesn't, right?
Well, see, I would argue that every industry pays for that in one way or another.
Indirectly.
Yes, you're either paying for it in rate or you're paying for it directly.
Did I answer that?
You did.
Okay, cool.
All right. Well, thank you. I appreciate you coming. Didn't mean to spend quite this long, but I appreciate all your time.
I appreciate you. Thanks for everything.
Anytime.